When shopping for a mortgage, borrowers will see an additional number called the APR, which stands for the annual percentage rate. Lenders are required to show the APR when advertising mortgage rates. The difference between the mortgage rate and the APR is usually quite confusing for many borrowers. The mortgage rate is what is used to calculate the mortgage payment. This interest rate, whether advertised or offered, does not give any information about the final and ultimate cost of credit. In other words, total cost of the mortgage. With the mortgage rate alone, a borrower cannot determine whether the mortgage being offered is a good deal in the end. The annual percentage rate, normally seen as APR, is a means of measuring the total cost of a mortgage over the entire period, from the date of closing to the date of final payoff. For this reason, the APR is always higher than the mortgage rate. The APR estimation takes into account the closing cost and prepaids, which may include items such as origination fees, points, mortgage insurance premiums, prepaid interest, and other expenses that may be required to obtain the mortgage. It is also estimated with the assumption that the loan will be held for 30 years and that the loan will not be refinanced. While one-time charges may increase the cost of the loan, the APR may appear lower because these charges are spread out over the life of the loan in this calculation. This percentage, the APR, is required by federal law to appear on the Truth in Lending Disclosure form. When a mortgage rate quote is given by a lender, it's necessary for the APR to be disclosed by the lender at the same time. These procedures are in place to protect the borrower as well as help the borrower make an informed loan decision. The annual percentage rate is calculated based on the assumption that the loan will be held for the entire 30-year term. Keep in mind that some fees may need to be estimated at the time of loan application, which will also produce an estimated APR. For adjustable rate mortgages, the APR is calculated based on the assumption that the mortgage is adjusting at the current period of time, even though it is unknown what the adjustment rate will be in the future. APRs for adjustable loans are calculated based on the current economic conditions and rates, which means that this figure can constantly change from minute to minute or day to day depending on the market. To truly compare mortgage rates and annual percentage rates, the borrower must ask the lender what is included in the APR in order to make an accurate comparison. Also know that a lower mortgage rate with higher points can result in a higher APR than one with a higher loan rate with lower cost. Even after comparisons, the reality is that the true cost of a mortgage may be dependent on the length of time that the loan is held by the borrower. Having these calculations and percentages are expected to help borrowers, but in the end, the better mortgage is usually the one that the borrower is comfortable with.